This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. Today's video, I'll be going over the data sets and doing a very quick technical analysis over the SPY for March 4th, 2026, and I will be streaming tomorrow morning at 8 a.m. Might be a little later than that, it might be closer to the 9 a.m. time frame, but I will be streaming in the morning, so hopefully all can join for that. Anyway, with that said, let's go ahead and jump straight into the data. Now for Tuesday, March 3rd, we really didn't have a whole lot of data. We just had some FOMC slash Fed speakers and, anything that's going on with the conflict in Iran. Aside from that, on Wednesday, we have fairly important data. We have the monthly ADP non-farm employment change. That's going to go over all of February, and the forecast is expecting 50,000. I don't expect that at all. I expect probably much closer towards that 20 to 30,000. At 9:45 a.m., we have, well, 9:45 slash 10 a.m., we have the non-manufacturing data. So it's, complementary towards the Monday data where we had the manufacturing side of the ISM data. This is the non-manufacturing side. It will be important to see the ISM non-manufacturing employment for February. Very, very likely that'll come up very slightly compared to the previous print, which was 50.3. As for everything else, the forecast is expecting slightly cooler numbers overall, so not much to say about that. It's not really data to move the market. If anything, it's that ADP data that would move the market. Nothing really too much in here unless we see something major out of the non-manufacturing employment for February. Now at 2 p.m., do have the beige book. Generally, that's fairly important, but in terms of the current context of the narrative and macro and everything, it's not really super important. We kind of know the Fed just wants to pause and wait right now. We're in a conflict with Iran. We have, the labor market potentially falling apart, but we have, potentially the economy picking back up from, the tariff, disruptions from last year. So they want to wait. We also have a new Fed chair coming in, I believe in May. It's either May or June, so right around the corner. So the Fed, for the most part, is pretty much going to be a state of pausing unless there's, a dire necessity to cut rates. Um, for Thursday, we'll go over that in tomorrow's video. Really nothing too much important for that day. The big data comes out mainly on Friday. Now, I would usually cover this in its own section, but we do have Broadcom earnings tomorrow. Now, that's pretty much the main earning this week, so that is in the after hours, so that's after tomorrow's trading session. Um, really don't have any expectation on whether they're going to beat or not. I don't really care too much. I just know that Broadcom's a very crucial company. It's up there with Nvidia. So with it being a semiconductor and with semiconductors really have held the majority of the weight over the past few month and a half of consistent downward consolidating, semiconductors have been holding the large majority of the weight. So if we see Broadcom do poorly or not meet the expectations of, you know, a major beat, then potentially that could be more weight that will pull down on the overall market. So with that said, let's go ahead and jump into the technical analysis.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis as always, let's go ahead and start with the daily time frame and go over the moving averages and Bollinger Band. So did have a very aggressive selling day, closed at 683, which is below pretty much every single one of our supports right now, besides, the 200-day moving average. We did not secure the lower Bollinger mechanics within the close today. That would have required us closing below the lower Bollinger. We simply had a push below that level and a rejection. Not exactly a bullish or bearish thing, but this does not trigger the lower Bollinger mechanics, so just be aware of that. With that said, with the market closing at 680.33, the 5 mile will be pulling down fairly aggressively. I believe I have it written on your screen. It's showing at 685.20. It could be around that level. It might be slightly higher, might be slightly lower, but that will be a very crucial level. Um, with this lower Bollinger rejection here, we do basically need to test that 5 mile. Now, if the market truly wants to go into full selling posture, they can ignore that 5 mile test. They do have plenty of liquidity. They can go for the extreme deep sell. As of tomorrow's open, we will have the 5 mile below the 10 mile, below the 20 mile, and below the 50 mile. So in terms of, positioning of the moving averages, it's almost as bearish as it can get. With the 10 mile and 20 mile, it's finally crossed under that 50 mile range, so we're starting to really enter into that longer term bearish trend. Now, we're not into a bear market yet, but this is starting to beginning to create the beginnings of one. Now, with that said, we're going to go ahead and turn off Bollingers and moving averages for a moment. I do want to show a drawing just so that we can kind of clear it out of the way and focus on something else. Now, I've talked about this structure quite a lot in the past, how each one of these buying and selling candles have held the exact same weight as the previous candle, which has been a very significant part because it means that every single move in here has been measured, okay? Meaning that it's basically equal weight. Any buying has been met with selling, any selling has been met with buying. Now, things change a little bit, and this is going to be the last time I show this drawing, so if you want to take a picture of it, go ahead. Let's go ahead and out of the screen a little bit, but we're going to change it over to this. And with this, we finally have a completed inverse cup. And it's a very large cup. Something that we've been talking about truly ever since this second major cup rejected. Or, the top of the cup rejected the breakout. Yeah, the handle pulled down towards the bottom of the cup, rejecting the cup structure entirely. And since that point, we've been entirely bearish. Okay. Um, with that said, we have now completed this structure. Based on the liquidity we've seen prior, the structure is now entirely completed. That said, with this structure being completed, we now have to start focusing really on these two major liquidity ranges. Okay, because very likely we're not going to be pulling back up towards that blue range for quite a while. So we're not going to focus on that right at this moment. Now, in the overnight, the market is pulling down towards that 676 range, basically the 677. Um, really nothing's hanging around there too much other than the lower Bollinger. So if this is really just trying to posture into, a major sell for tomorrow, then they're really just trying to position price below that lower Bollinger so that they can really secure that level for the close. That's what I'm assuming with the overnight price action. However, the expectation should be to be pulling up all the way towards the top of this liquidity channel. Okay. Reason why, that one, we completed this large inverse cup. With us completing this cup, you're now starting to expect bullish structure to build at the bottom of this and to start building an inverse handle, basically a nested inverse cup, to create more liquidity to pull us back downward. Okay. That's really what we're looking from everything currently. Now, with that said, all of the moving averages are above us. With this pulling back upward, which that's my expectation from is to pull back upward, retest the 5 mile, and from that 5 mile retest, have a major rejection. Okay, that's what I'm fully expecting out of the current price action. Now, granted, this is the daily time frame. This is going to be occurring. Very likely it'll be happening a lot faster than what is drawn here. But we also have another scenario that can be playing out, and that is this turning into a very large head and shoulders. Now, if that's the case, potentially we can pull back up here, test that 5 mile, see success from that 5 mile test, and then start pulling into that range, probably reject that 20 mile, back down, rinse, repeat, have some consolidation in there, and then pull back downward. But the true level that we're aiming for here is down at that 646 range, actually slightly higher because of dividends, but that's the liquidity range that we're looking for. Um, I don't fully expect this head and shoulders to play out, but that's something that we can see starting to form here is that we have been seeing bearish structure guaranteed at least the last month and a half now. With the structure closing today or yesterday, whenever you're listening to this, this does confirm that this bearish structure has been building since December. So this is telling us that very, very, very likely the goal is to push back down towards this liquidity that market has aimed for previously. As you can see, both of these selling ranges have been trying to grab towards that range. So it's kind of hard to see, but you see a very slight pull up, pull down, a lot of messing around with this area, back up very slightly, pull down, a lot of messing around with that area again. So I do think that that's the goal is that they're going to try to aim for that range. We do have quite a lot of consolidating to do before that, just pulling up the moving averages and the Bollinger Bands. We do have to see, bottom Bollinger pushed, 5 mile retested, 20 mile retested, rejected, push down again, rinse, repeat until we see enough price action that push down into that range. Um, Even with the overnight price action, we are still above this, this consolidation range that I talked about. And with the low of today, saw the low hit 66, 669 and 66 cents, which is $4 below that range. But with that, being below that range, it sat below that range for a very, very short period of time before pulling back up. That doesn't mean we're entirely done with this range. It just means that now we need to start building some support to really break down this consolidation range. This bottom consolidation channel is extremely strong. Each time we've hit it, we have basically rallied extremely hard. Um, Not that that's what I'm expecting here. We're seeing a lot of bearish structure, have the moving averages in very, very bearish position. The only true bullish signal I'm seeing right now is that the ADL on the daily time frame is pulling up very aggressively. On the weekly time frame though, it is starting to taper out, which can be a signal that we will be seeing daily slowly starting to taper out. Now, that's going to be the technical analysis for SPY tonight. Let's just go ahead and look at the hourly, see if I notice any major structures. I would be pretty much looking for, it's terrible. I'd be looking for this inverse cup back down to that 669 range. That looks extremely good at this point. We might have that pull back upwards towards that 5 mile range, test that range. The likelihood is though is that we are very likely rejecting it. Now, just quickly going over volatility, as you can see, it's extremely elevated. It is above that $20 range, which that's that range we've been talking about, where we do expect market to start trading between this area. And if we do start seeing the market trading between this range, that will really signal that we are with the bear market. The VIX is still just absolutely soaring, and it's not just soaring. As you can see with some of these prior VIX major candles, it likes to pull up very quick downward. This is actually forming basically a buying trend in terms of VIX insurance. Okay. Um, that's a very dangerous signal. Generally, when you see these major buying trends, they generally tend to get into major selling. Um, but be cautious of that. This is starting to get to an extremely dangerous range. Um, what I'm going to close on here tonight is that to show this one moment, the FXY. Because again, we're still at this very low territory. Um, again, and this is to show weekly time frame. Each time we've gone down to this range, had a massive, excuse me, intervention within the yen. Now, either yen is about to entirely fall off a cliff and we're about to see it really pull downward and some major issues happen in Japan, or we're any moment now going to be seeing this unwind. We do see the DXY pulling up very aggressively, which this is a signal that I was looking for. We were looking for the DXY to start pulling back upward. This would tell us that, the initial selling is starting to take place. Institutions are starting to get into dollar positions. And with dollar positions being entered, that means that there is less dollars in circulation, which that's why there is the increase within the DXY price. However, I think the next step to seeing this sell-off continue is to now see the DXY start to push downward. And what I'm expecting is a lot of this DXY weight that has pushed into, the dollar to really start pushing into the yen. And just to kind of correlate this all, the USD JPY, let's go ahead and show the weekly time frame. This is showing the correlation between the DXY and the FXY, the dollar and the yen. And again, each time it pulls up to this extremely large range, we've had a major intervention. That's the intervention of 2024. This was a minor intervention in 2023 that really not many accounted for at the time because we didn't really consider the whole yen carry trade because that doesn't matter much. Um, this was again 2024, 2025 with the selling between February to April. And again, here we are in February with, an extremely elevated USD JPY. Another signal that I want to end tonight on is that we have been looking for liquid to pull downward towards that 110 range. Truly, we were looking for the 110.50. However, we pulled down all the way to the 110.17. Currently, in the overnight and the after hours, it did pull all the way back up to the 111. However, we're starting to see selling within liquid. Let me show this within the actual daily time frame for better context. but within the daily time frame, we're actually starting to see some selling, and we also see this mirrored very well within the HIG. The HIG is starting to show us those signals of that sell-off. Um, and the prior circled ranges are we had, let's see, yeah, that's when we had the other previous unwinding events. Um, the HIG obviously sold off very aggressively here. Doesn't look like it. Um, it was just a very, very quick sell-off. But with that sell-off, we saw a lot of treasury buying. So that's why we saw the HIG kind of be bought upward at that point. And remember the sell-off that happened in late July, early August was fairly quick compared to the one in 2025, where it lasted almost for a period of 4 months. So potentially we could be, you know, really getting ready to enter into a bearish market. Now, one thing I do want to show is when we were actually in a bearish market, and that's between this range. This is that 22 or 2022 to 2023 range that I keep talking about, is that you can see within the HIG, you see a lot of selling, selling, buying, selling, buying, selling, buying, selling, buying. However, once we get to the or the bull market, it's almost entirely buying to the upside. It's entirely buying, just a little bit of selling. So this really does show how, you know, when volatility starts really becoming injected into the overall top echelons of the market. Um, so far we're not seeing that massively present yet, but the signals are starting to show. Again, this is the top echelon of the credit markets, and seeing these starting to sell off is a major concern. So, okay, that's going to be the end of my video. If you have those S full puts like I do, at the 16 strike puts for April 17th, you just continue holding on to those, and those should be worth quite a bit in about a week or two. So, looking forward to that. Other than that, thank you for watching. I hope you all had a great trading day today, and I hope you have a great trading day tomorrow. Um, Covered it all. Thank you all for watching. Thank you all for, liking my videos, subscribing, commenting, helping with the algorithm. It's all great. It all helps. And let's have a super great trading day tomorrow. I will be streaming and I hope to see you all there. So take care, everybody. I'll talk to you in the next video.